Welcome back. You're watching us here on Chartbusters. It's been a strong listing for electronics manufacturing services provider Syrma SGS Technology. Sandeep Tandon, the executive chairman of the company, joins in. Opened at a 20% premium to its issue price, and now it's up almost 30-odd%, virtually at the high point of trade. Sandeep Tandon, the executive director, joins us now. Sandeep, thank you so much for joining in. Of the 840 crore IPO size, you're using 766 crores as a fresh issue, and most of that would be deployed into plant expansion and working capital requirements. Can you give us a sense? Okay, we're just trying to repatch that connection, just trying to, see if Sandeep can hear us or not. Sandeep, can you hear us? On our radar, Sandeep, can you hear us?
Yes, yes, I can hear you.
Perfect.
Thank you.
So, Sandeep, that's the first question that both Nigel and I, we were just discussing. 766 crore is the money that you're raising as fresh capital going into the company for both working capital deployment and also deployment towards plant expansion. Can you give us a sense of how much of that would be for plant expansion, and what could the asset turnover on the expansion that you're going to undertake be?
Yeah, so about 500 crores of that proceeds are going for plant expansion. This is between greenfield and brownfield. We've already added one more plant in Manesar just recently this quarter that has just started, and one R&D center in Chennai. So expansion of R&D and greenfield and brownfield facilities that will be deployed over the next 18 to 24 months from the projections that we are seeing from our customers. Typically on the equipment assets that we put, we get about 5 times growth, but it does take time to build that out. So we have to prepare for the infrastructure first, and then add more equipment and facilities in there. Within that equipment and facilities, we usually see 5 times on our asset.
Yeah, so Sandeep, you're saying growth. Sandeep, first of all, congratulations. Welcome to the stock market. It's a good listing. Seems you and the bankers priced it perfectly. You have larger peers out there, which has created some bit of excitement, and more importantly, the money is going back to the company, so the street likes that. But to take that point, you're going to be spending close to around 500 crores, 5 times asset turn. Is that correct? What you were talking about? 5 times asset turn. So at peak, you can generate.
Yeah, so 5 times on equipment turn. So yeah, so between infra and so infras we have to expand further, so that doesn't give return right away.
Okay.
But when we start adding lines and equipment, that those give about 5 times turn.
No, so what I'm trying to understand is this 500 crores you're going to spend at peak levels. What kind of revenue you can generate from here?
So about 2,000 crores from this.
2,000 crores is what you can generate from only this expansion. And last year you did around 1,250 crores with the old capacity. At peak levels, what can that generate in terms of revenues?
So that should be another 2,000 crores.
How is it that 1,250 crores also accounts to 2,000 crore, and the 500 crore that you're doing is about 2,000 crore as well? Is there a difference between the two? And can you also give us a sense, because I'm looking at your
current last year's turnover you asked, right? I'm not sure.
No, I'm talking about the capex that you did last year.
No, we didn't do 1,250 last year. No,
Okay, so 1,250 crore is the revenue that you did last year, and 2,000.
The revenue. That's why I was confused. But yeah.
Okay, take that point. So you're saying that this 500 crore can yield you revenues of almost 2,000 crores. But apart from that, you have some other gross block as well. I mean,
but
11 plants.
What we are currently currently working. Yeah.
So you're currently working at what capacity utilization?
So we are currently at about 75% utilization.
So peak capacity on this would imply revenues of close to around what, 1,600 odd crores?
Yeah.
Okay. And by when?
I didn't catch you. What is?
No, by when? By when? Okay. So what we're trying to understand.
So we are expecting. So yeah, go ahead. Maybe I'm not understanding the question.
No, we are just trying to get a sense that at peak levels, what we understand now, going by your current capacity as well as your expanded capacity, you can hit around 3,500 to 4,000 crores. Is that correct?
Yes, correct. That's
okay, all right.
That is correct.
When does the expansion come on stream? This 500 crores that you're putting on?
So we've already started, like I told you that we've started expansion already. One plant in Manesar has already been acquired, and we've just started this quarter, fired that plant this quarter. And R&D center in Chennai is just started also, that we started last month. That is another expansion that we've already done. and that will, and then there are about 2 other brownfield expansions and 1 greenfield that should start over the next, like I said, 18 to 24 months. We should be able to deploy this.
It's interesting that you are, deploying some money towards plant expansion, because from what I see in your red herring prospectus, you have about 11 manufacturing facilities, of which only 4 contribute to majority
Correct.
of your revenue. So what happens to the remainder 7? Are you looking to
Correct.
offload them, sell them, or you are?
No. India has to be managed in a very different way than China. So we don't believe in, one large plant. So we actually have what are these other plants are what are they called satellite facilities, where the capex is not heavy. It's more to be closer to workforce where there's labor intensity. So we try to do a lot of labor intensity closer to where the workforces are, and then we drive those plant to the parent plant if required. So,
Okay.
So that's why you don't see all the plants being equals. They're actually very strategically done so that we have more, it's a way we're playing India out, right? Because moving workforces is very challenging. One large facility, you don't have disaster recovery plan. So that's how we played this out. So it's actually the synergistic plants that we think of the way we do it.
All right, Sandeep, let's pick up the pace now. ODM as a percentage of your total revenues, I think is around 30%. Where is that number headed?
Yeah. So I think it should stay there because there's a lot of growth coming. So 28% is what we are at, and I think we should continue being about 28 to 30% in our ODM capability. Now that we're adding much more R&D over maybe next 2 years, that there could be opportunity for growth in that capability.
What's typically going to be the R&D spends per year, Sandeep?
So R&D spends are, they're not, they're not huge spends because we actually, it's a revenue source for us, right? So we don't burn the R&D. It's part, we work with the customer, so it's actually billed to the customer through the product. So
and what is the average tenor of customers that you have? Because what's the average tenor of customers that you have? Because last year you added what, 158 customers?
No. They were not added last year. So we have a total of. So what we do with the customers, right? When we initiate a project, it becomes what we call a NPI, which is new product introduction, or a prototype build. So that we want to keep a very large funnel available. So these customers eventually will turn into revenue generating, huge revenue generating customers.
Okay.
So we engage with customers because with our engineering skills, and then we supply them the prototype, and then some fall into revenue, some don't. But these are customers but our tenure with our customers are extremely long. We have customers who've been with us constantly for 16 years, and we continue
Sandeep?
to engage with customers. So very, very rare. Yes, sorry.
Yeah, Sandeep, let's wind this down. Then we got your focus, but very quickly, what is your revenue number likely to look at for this year? 1,260 is what you did last year, and your margins last few years have been between 11 to around 16%. So for this year, what is the margin band? Very quickly.
So we want to stick to the same margin profile that we had last year. That's our aspiration. And growth we want to hit. We are aiming for industry is growing at 40%. We should try to match industry growth.
So for this year, you'll do around 1,700 crores of revenues at least, with margins of around 11 to 12%.
Yes.
All right. Take that point,
Yes.
Sandeep. Thank you so much for joining in. Congratulations once again.
Thank you.
For entering D Street. The important part now will be maintaining the growth and going ahead and meeting your word with your action out there. That's how it pans out. Both of us will speak to you on a quarterly basis as well. With that, we wrap up on this edition of Chartbusters. Stay tuned. Trading Hour comes up.